But if you buy a property 20 years ago for $1 million and you sell it today for 4 million, you can keep that whole $4 million intact.
Hello, everybody, and welcome to Get Diversified. I have a very cool guest here with me today that's going to be talking about a variety of real estate topics. His name is Ben Carmona. And Ben, welcome to the show.
Yeah, thank you, Jacqueline. It's great to be here. Thank you for the opportunity.
All right, well, let's just I'm going to read here how Ben say he wants to be introduced in the podcast. I'm sure it's not everything, but I'll let him kind of continue on with the introduction. So Ben is a managing partner at Perch Wealth. He has more than 20 years of applied experience. Ben is an expert in 1031 exchanges, DSTs, and real estate investments, the structuring of the investments, and different strategies. So I am super excited. There's a lot in his years of experience, but I'd like to talk about 1031 exchanges and DSTs, and then we can spend about 10 minutes or so on alternative investing and the importance of it when it comes to a diversified portfolio. So, Ben, what did I miss on the introduction?
No, you hit it on the head. That's perfect. And I'll just describe a little bit, provide a little bit more color because I didn't include there. So I'm a financial advisor, right? So I'm securities licensed, but I'm not your traditional advisor that's doing stocks and bonds and mutual funds and annuities. I am solely, exclusively focused and an expert in real estate syndications and all sorts of alternative investments, which we'll describe, a little bit later on. This is all I've been doing for 20 years. And now, so as an advisor today, I'm helping clients, recommending investment strategies. If they're in a 1031 exchange, I can help with that. If they have cash that they're looking to invest into an alternative investment strategy to drive income, more tax efficiency, growth, I can do that as well. Prior to starting Perch Wealth, I spent 15 years on the syndication side, manufacturing these very same investments, right? So buying the real estate, doing the underwriting, the due diligence, training and educating financial advisors and CPAs and attorneys like myself nationwide. And so I'm advising the very products that I built for so long.
Fantastic. Well, first of all, thank you for being a financial advisor that doesn't just think stock, bonds, equities, annuities, and all the things that I used to see when I had a W-2. And I love that you give people the opportunity to think outside of the box. And it's really not even outside of the box. It's just different than a lot of financial advisors are out there selling. So cool. Let's get into it. So a lot of our users or a lot of our listeners and viewers may not know and understand what a 1031 exchange is. So let's just start by talking about what a 1031 exchange is and some benefits, and then we'll kind of continue on there.
Yeah. IRS code 1031, Internal Revenue Code 1031, has been in the tax code for over 100 years. And arguably it's the most powerful tax advantaged code that's in existence. And basically, the IRS allows you, an investment property owner, to sell your property and defer paying any taxes on the capital gains, if you will, as long as you take the proceeds from the sale of that investment property and exchange into other investment property. All right. So, and I'll just come back. It's only applicable to investment property, right? Those properties held for business or investment purposes. It can't be your personal residence. And so, and really, the 1031 exchange is the reason why so many investors own real estate, why they want to get into real estate, because essentially you can, Jacqueline, if you buy a property 20 years ago for $1 million and you sell it today for 4 million, you can keep that whole $4 million intact as long as you exchange into other investment property. So we call it, you swap until you drop, which means you exchange and you exchange and you exchange. And then one day you pass away and all the taxes that have been deferred all these years go away. And your beneficiary, your kids or your beneficiaries, inherit that asset or those assets at a stepped up cost basis, right? So again, you started at $1 million, 50 years later, you got $15 million. If you were to pay tax and not do an exchange, you'd probably owe, I'm making this up, but $7 million in taxes. In this case, your son would get the full $15 million. That's a beautiful thing, right? So that is the essence of a 1031 exchange. Now, the IRS has blessed us with this opportunity, but they don't make it easy. And so I can go into some of the rules or guidelines if you like, but I'll pass it back to you.
Yes, I would love that because I heard it was a pain in the you know what. Let's talk a little bit about and outline those because I think it's important for people to know and understand that because deadlines are a big deal when you're talking about a 1031 exchange.
Absolutely. So the first one is you have to buy equal to, if not more, real estate relative to the property you sold. So again, if you sold $1 million property, and let's just say you have $500,000 of equity in that, and you have a $500,000 mortgage. So you sell that property. Obviously, your mortgage gets paid off. Your proceeds go to what's referred to as a qualified intermediary, which is a third-party escrow account. So you have 500 grand sitting in this account. To complete an exchange and defer all taxes, you need to take that 500,000 and buy a property of equal or greater value. So in this case, $1 million or more. So what does that require you to do? Okay, I have 500 grand. How am I going to buy $1 million property? Well, you have to go out and get another loan, right? Or you could add another 500 grand to the table if you had it, but you need to buy property of equal or greater value. If you were to sell the million and only buy $900,000 worth of real estate, you would have to pay, they call it boot, and you pay tax on, the $100,000 shortfall. Right.
Okay.
So
Is that tax basis less, like a less of a percentage, or do they tax it as if it was a capital gain, or does it get taxed at a lesser percentage?
no, it gets hit like if you're gonna owe, 30% in taxes, right? State, fed, depreciation, recapture taxes, and it's 30%, we'll call it. And you're short $100,000 on your exchange, you would get hit 30% on the 100,000. So that's the first rule. You got to buy equal to, if not more, real estate. The second one is the timeline, and this is where folks really start to panic, and makes it challenging. The IRS states that you have 45 days from the day you close escrow to identify suitable replacement properties, right? So you have 45 calendar days, not business days, calendar days. And during that period of time, you can you could change your identifications as many times as you'd like. But once that 45-day period expires, the properties that you have identified for potential exchange are the only ones that are allowed, that are the only ones that you can exchange into. So for example, we close escrow today and you, Jacqueline, say, all right, I've identified these 3 properties. I love them. I'm either going to buy all 3 or I'm going to buy one, whatever it may be. 45-day passes, right? So those 3 properties that you identified, that's all you can do. And then boom, 2 of them fall out of escrow, right? For whatever reason. You back out, they back out. And then the third one, you can't get the lender to approve financing on it. Well, in that case, you're out of luck, right? You're going to pay taxes. So it's not only that short period of time, and 45 days may sound like a lot, but like it's not, right? You have to go out there and find suitable property, do your underwriting, due diligence, line up loan term, or financing if you need it, all sorts of things. So it's the timing, the timeline as a rule that often is probably the most stressful of the rules. And then the last thing I'll say is, so you have 45 days to ID. I passed that 45-day ID period. You have an additional 135 days to actually close on those properties identified. So that's where, if you look it up, you have 45-day ID timeline and then 180 days in total to close your exchange.
Do you ever see that those timelines would change, or has that always been the way it's been?
Always been that way. It'd be great if they extend them, but I don't see that happening.
Okay, cool. Well, yeah, that seems a little difficult, especially if you close on your property in October and November, and then there's not much on the market. What do you do? Do you often see people getting into investments that may return a loss just to complete the 1031 exchange?
I don't want to say a lot, but yes, right? Some folks will think if if you're facing a major tax bill, right? Or you can just close on this property, even though it may not be performing all that well. It's a decision that investors have to make sometime.
Yeah, we often see properties here where like something sold for well above what we would have proposed the price to be. And then we always say, well, you never know the person's situation on the other side of the table, right? So maybe they did have a 1031 exchange and they were like, the hell with it. We just need to get this closed. And while I'm overpaying for it, it doesn't really matter because it's more beneficial to them from a tax benefit to not get taxed on that, whatever money they made on the sale of that property. So I always kind of think about, well, maybe they're not dumb. because that's the first thing that comes out of my comes out of my mouth is, "Oh my gosh, what dumb investor you are." There's other circumstances that come into play that most people don't think about, and 1031 is one of them.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.